Good morning, guys, and welcome to the podcast. Today's talk is all about the four pillars of real estate diversification. And with that, I have Lon Welsh, and he is a entrepreneur, he's an investor, and he's been featured on podcasts such as Denver Real Estate Investing. He's the founder and CEO of the largest independent Colorado brokerage, Your Castle Real Estate. Got over 750 plus agents. He's done over 2.8 billions in sales. He's done a lot. He's contributed a lot to thought leadership, written a lot of books. I've made a lot of guest appearances. So I'm really happy to have him on and talk about his area of expertise. We're going to talk about depreciation, 1031, and it's going to be tax advantages, etc. Lon, welcome.
Thank you for having me today.
Yeah, you have a very impressive background in real estate, and a lot of the listeners and viewers, they are investors and they love real estate because of this depreciation. So talk about your journey and how you got started, and we'll dive into the questions.
Yeah, my background is in corporate finance. I went to business school, and when I got out, I worked as a strategy consultant for 8 years. And I remember signing up for a 401k when I started at Deloitte, using one of these financial calculators to figure out how much money I'd have to save out to be able to have a retirement. And the rule of thumb was you could take out like 4% per year, and that translated to this god-awful big number. I'm like, how am I ever going to save this much money? So I started looking at investment real estate and said, wow, the returns in real estate are so much better. I want to do that. So that's really how I got started. So I started buying my first investment properties in 1998. So I've been through a couple different market cycles. I got out of consulting, was a commercial real estate broker for a couple of years. Then I started a real estate brokerage called Your Castle. I grew that to be the largest independent in Colorado. I sold that to a private equity fund in December of 21. So I'm still on as a CEO, but I don't own it anymore. And then I launched a private equity fund of my own called Ironton Capital in July of 22. So we're just coming up on our 3-year anniversary, and we manage about $85 million for people.
Yeah, very impressive. And you've definitely achieved great success in this industry. And what I love is these, a lot of listeners and viewers, they know how to diversify using real estate, but you talk about four pillars of diversification using real estate. And I'm just curious what that is.
Yeah, it's interesting when we invest in the stock market. It's some people have a passion for researching and picking individual stocks. And if you like that as a hobby, that's incredible. But most people don't. So they'll just put their money in like an S&P 500 index at Vanguard or Fidelity, or a global market index of some type or another. And you can achieve a lot of diversification. And it's almost take it for granted with stock market investments that diversification comes along with it, because that's the technique that we use. What I often see is I've written 13 books, most of them on real estate investing, and I've given a lot of classes on real estate investing to people. And usually what happens is they'll buy one single family property as a rental, and then a second house and a third house. And if they do really well, they might have 15 or 20, but it's very concentrated, and it has the opposite effect of the diversification you achieve in the stock market. So in the Denver market over the last couple of years, there's been 13 different pieces of legislation passed by our state government, really transferring power from the landlords to the tenants, making it a much more adverse environment to be an investor. And if all of your investments are in Colorado, like, you've really been punished by the set of legal changes that's happened in the last 36 months. So the types of diversification that we like to think about for our fund when we're helping our investors invest is, the first is geographic. I like to have our national diversified fund be in at least 10, ideally 12 to 14 different states, so that if there's a change in the state laws, only 1 or 2 of our buildings get impacted. I try to have 30 to 40 different commercial properties in a fund. If any one property has a problem, it's not adversely impacting the entire portfolio. For example, you might remember there were 2 hurricanes, not one, that hit Tampa last fall, and we had a building in Tampa. So I wasn't losing a lot of sleep knowing that my entire portfolio was going to be under a flood surge. It was just the one. So geographic diversification is really important. The second is asset class. So we have a lot of multifamily, but we also look at hospitality, industrial, self-storage, and student housing, because not every asset class moves through the economic cycle in the same way, and that diversifies some of your risk. Similar, if you're in the S&P 500, you wouldn't want to all be in healthcare or mining or utilities. You'd want to have a broad spectrum of industries, because some do great, some do bad, and they offset each other. The next is we like to have sponsor diversification. So if you're an active manager, running all of the properties yourself. You're the sponsor, and every sponsor's got their own strengths and blind spots. And if you have all of your properties just with one person, you'll have a lot of that same blind spot Xeroxed over and over again, and that can lead to some trouble. And then lastly, we have strategy diversification. So there's really three main ways to make money in real estate. You can do buy and hold. So you pay a relatively high price for a great asset that's already performing. We don't do any of that. You can build something new from scratch and go through the development cycle, or you can take an existing property that's been neglected, add value to it by renovation or getting a new management team, and raise the rents quite a bit. The last two are the ones that we like to focus on. So our goal is to balance out the risk across these four different pillars of diversification to take away some of the risk in the same fashion that you enjoy investing in a mutual fund for stocks.
Yeah, I really love that. And then we'll talk about how real estate is very capital intensive, and there's you mentioned a lot of extraneous risk these days with tenants and with tornadoes, hurricanes, and it's almost wiping out all your gains. But the reason why a lot of the listeners and viewers love real estate is because of the tax advantages. Like, they're high income and they try to use it to offset their W-2. And one thing is, I think the audience is very familiar with depreciation, but they may have heard of 1031. Some of them may have used it, but you talk about getting off the 1031 treadmill without losing your tax advantages.
Yeah, so our long-term investment fund has two share classes, and one of the share classes gets a slightly higher preferred return, but it gets none of the depreciation loss. So if you're an investor using a 401k to invest with us, for example, which is very common, you can't use the depreciation in your 401k, so you'd rather trade off the depreciation, get more preferred return. Really pleasing for that investor group. The other investor group tends to be people who have been active investors like myself, who are selling a property that maybe they've owned for 10 years. It's appreciated a lot, and there's going to be a lot of capital gains that's going to be due. We can concentrate all of the depreciation just into that one share class, so they get a disproportionately large amount of depreciation. You'll want to check with your CPA and financial advisor, but in all the cases we've had so far, the depreciation we give you can be used to offset your capital gains and your depreciation recapture when you sell a property. That's usually enough to offset most of the gain, not all of it. So it's like a synthetic 1031 exchange. You might remember when Trump was in office the first time, there was a tax reform package, and they greatly accelerated the recognition of depreciation in some situations. And it was really helpful for real estate investors. And the discussion is in Congress this time that is going to be renewed with this tax package that'll be coming out shortly. If that's the case, if you sell a property, not only will I be able to wipe out your capital gain, I'll probably be able to give you some extra depreciation on top of it. We have a good way to accomplish what you've enjoyed with real estate synthetically.
Yeah. And we will also talk about Trump, because no discussion about real estate is you have to include Trump in, because he was a real estate investor as well.
Yeah,
So,
helps us out.
yeah. So the next question I have for you is, in these days, a lot of people are like, I think traditionally there's still people such as yourself, like very active, very successful in real estate. But for like new people, like they feel like real estate is they're priced out, or just there's a sponsor risk, there's tenant risk, there's climate change risk. And a lot of times now they like the insurers won't insure. So it's like harder and harder. And so how do you, as an investor, how do you look at these? Because I look at my like property management and property tax, and I'm like, over half the gains are eaten up by these fees. How do you address these for new investors?
It's really a challenge for the people who bought several years ago. If you bought in, say, 20 or 21, when the interest rates were really cheap, and before we saw these incredible increases in insurance and property tax, for example, you built a financial model to buy that property that no longer exists today. And when you have a refinance, it really makes it difficult. The good news is that for the people who haven't bought something and they're about to buy their first investment, whether it's passive or active, if you're buying on today's economics, you're expecting an interest rate somewhere probably close to 7%. And you're expecting insurance that's in the stratosphere. Many experts think that we're probably near the top of the insurance cycle and that prices may come down a little bit. I wouldn't count on it. I would still budget for increases, but that's one possibility you might model. And if you can achieve the cash flow that you need to achieve with this really difficult environment that we're in right now, if anything improves over the next 5 years, you're going to really be the beneficiary of a large gain. So it's actually, surprisingly, a really good time to be a buyer right now.
Interesting. And also talk about just a lot of places. So for example, I was reading there's areas where it's like blacklisted by lenders or by insurance carriers, and a lot of places like homer investors, they got in, now they can't sell or refinance. Where should one be parking their capital short term during especially political volatility, economic volatility, uncertain markets, interest rates, etc.?
We've got two short-term funds that help our investors with that. So that wouldn't be the only option, obviously, but it's one. So we have a short-term fund that pays around 8%. It's very liquid, and it's taxed as a REIT, a real estate investment trust. So it's got favorable tax handling. And we have a medium-term income fund that generates 11 to 13% returns. It's tied up for a year, like a CD would be, and then it's liquid after that. So a lot of our investors are doing that in the near term while they sort out what's going on in the market. Interestingly, we've got a lot of fix and flip investors at the brokerage who tell us, I'm out. I'm just going to wait on the sidelines until I see what's going on. And they're parking it in the medium term fund for a year or two till the dust settles, and they're going to go back into the market as active investors again. But that would be an option. There's an awful lot of funds like ours out there that can provide either lots of liquidity with a lower return, or maybe trade off some liquidity for a year for a much higher return and then just wait out the storm.
Yeah.
It's a terrible time right now.
Yeah. Yeah. And everybody thought Trump coming in, everything was going to be booming. Obviously, he's reversing a lot of things, reversing a lot of damage that's been done over the last 40, 50 years. But where do you see he's trying to get rid of Jerome Powell, interest rates, you got tariffs. He's also a real estate investor. So how are you positioning yourself in this kind of Trump administration?
We're going on an assumption that interest rates will probably be relatively steady. There's a lot of popular discussion that the 5 and 10-year Treasury are going to go down, and I understand the logic for that, but I'd rather be pessimistic in our assumptions and still guide to a pretty good return. And if we get any relief at all, then it'll just be extra icing on the cake. It's a pretty tough market to forecast interest rates in right now. I'm glad I'm not a bond trader. My livelihood depends on it.
Yeah. Yeah. I talking to a lot of other real estate investors. They're like, just see what's happening, and the numbers work out. What are you also talk about the 8 factors of due diligence, and what are those for early new investors listening or watching?
I should have printed that out so I'd have them right out in front of me here. I tell you what I want to focus on is on one or two things that I think are the very most important ones. And actually, if you guys leave with any messages today, this would be the one message I want to have you walk away from. So when you talk to a newer investor in syndications or a fund like ours, the questions are a lot easier and the due diligence is relatively shallow. When you talk to a family office or an institution, it's a lot more rigorous. And the one thing that the family office does that the newer person doesn't, and this is what I want you to learn, is that they try to sort out, when you've had a good result as a sponsor, was it luck or was it because of skill? And I'm going to give you an example, and this is embarrassing for me, but it's true. My first fund, my best investment, we did a build-to-rent community outside of a large city in Texas, and we ended up returning a 57% annualized return after expenses to our LPs. And I'd like to tell you that I'm a genius, and that was a result of this incredible methodology that we've got. And we do have a good methodology, and we do a lot of hard work. Honestly, we earned price something that should have been like in the mid-20s, and we got really lucky in that it turned out to be in the mid-50s. Why is that? Something you might want to look at when someone trots out, here's like my trophy investment that I made. I made that investment in March of 2020, and I sold it in April of 2022. And if I just told you that, what would you tell me?
If you probably bought at the bottom and sold at the peak, is
We
what
did.
like.
So
Yeah.
within 15 days on either side. It could not have been any better. We got this thing just right after COVID started and everybody was in a panic,
Yeah.
and we sold it at the absolute top dead center. So if you guys recall, COVID really became a panic in early March of 2020, and the Fed flooded the market with lots of cash shortly after that because there was just total panic. It was like a 45-day period where you could pick up assets for next to nothing because people were just shedding assets, and we picked one up at a really good price. And through 2021 and the first quarter of 22, the interest rates were like as close to zero as they could be. And then from April of 22 through December 22, they basically more than doubled. And it became a very unfavorable environment to sell. And we just nailed it. So most of the extra return that we got from that was due to spectacular timing and honestly just a lot of good luck. So I want you to bring that degree of sort of skepticism when you take a look at results. The offset from a due diligence in Fund One, I had 8 investments in Fund One. One of them, I bought an office park, really nice office building outside of Houston that needed to be renovated. And we bought it 3 months before COVID, and we lost everything. There was no return on that whatsoever. I hope you'll be as charitable in evaluating me on that as you will be in being stern with me on the other investment. So make sure that you take a look at how much was luck or timing a factor in what's going on. That's the number one thing by far that I try to teach people. I actually have got a book which I'll give free to your listeners if you guys want it. If you go to irontoninvestments.com/financial freedom, so that should be easy to remember. You can download a copy of my book on passive real estate investing for free as a thank you for tuning in today. And we go through all the due diligence in detail there.
Yeah. Rounded out is in this kind of crazy environment, I see a lot of investors, they're like, yeah, US is past its prime. It's done its thing. China, India. Talk about why you think the US economy is still the envy of the world.
Oh, wow. There was a great article in The Economist magazine. It's probably been 6 months ago now, where the cover story was the US economy being the envy of the world. And there was a number of economic factors that were listed in there. I'm going to botch one of these things as I'm not an economist, but one of the things I remember reading is that Amazon's research and development budget is about the same as what Britain spends on R&D, just one company alone. So the amount of investment of our tech companies to push things forward has really, if you take a look at our stock market, the Magnificent Seven, the tech stocks have really powered a lot of the gains. And there's really no analog to any of those types of companies anywhere outside of America. We're very fortunate. We have a culture that rewards and tolerates entrepreneurship, risk-taking, innovation, some losses, and a few really spectacular gains. For real estate, though, I think the main thing is Fannie Mae has done a study showing that they think that we are undersupplied for housing by 3 or 4 million units. And every other large economic think tank that studied it came up with a similar number in the multi-million range of we're just short of housing. As long as there's a huge amount of demand for housing and there's not enough supply to go around, that's just economics 101. It's going to be a really good time to be an investor.
Interesting. And for people that want to connect with you and learn more about you, how you can help them, educate them, and even how can they connect with you and learn from you?
Yeah, you can go to Ironton, IRONTON, capital.com. And there's a button on there you can use to set up an appointment, or you can go to irontoncapital.com/financial freedom and download the book. And I think you'll get an opportunity to set an appointment after that too. But I'd love to talk to any of you guys. And I've got 4 of the people on my team that even if you're a newer investor and just trying to figure out which way is up, we're happy to talk to you and try to give you a blueprint to success.
Excellent. Well, I really appreciate, and the audience really appreciates you coming on and talking about real estate and tax advantages, and a really fascinating conversation, and keep up the great work.
Thank you for having me today. I really appreciate the time.